Kenya's vibrant tech ecosystem, which has been called the Silicon Savannah, has long been classified among Africa's Big Four. That's alongside Nigeria, Egypt, and South Africa. Financial technology, or fintech, is among the areas that have seen a lot of innovation in Kenya, although increasingly we are seeing a crop of interesting solutions across artificial intelligence and the larger climate tech pool. However, there has been reduced investments in 2024 compared to the highs of 2022 and the first half of 2023. While the complete numbers for 2024 are not out yet, the first half of this year saw Kenya take a third of the investment poured into African startups. Records from the funding database, Africa the Big Deal, for instance, show that between January and June of this year, African startups raised $780 million, excluding exits. Kenyan ventures alone received $244 million during this time, which is 32% of the continent's total. So let's take a look at some of the major venture capital deals we saw in Kenya this year. Kicking us off is Copa. The asset financing startup secured $51 million in debt financing from the US International Development Finance Corporation in May. The startup was co-founded by Nick Hughes, Chad Larson and Jesse Moore in 2010 and has been providing underbanked customers in Africa with products such as solar lighting systems, televisions, fridges, smartphones, and digital financial services. The company is British but Kenya-based, from where it also serves Uganda, Nigeria, Ghana, and South Africa. Coming in second is Busigo. Now, the Kenyan EV startup founded in 2021 by Jit Bhattacharya and Jonathan Green was among this year's most funded local startups. Busigo provides electric buses for public transport use under a pay-as-you-drive model. In March, the company received a $3 million investment from Toyota's parent company, Sifao. The company followed it up in October with a $42 million debt equity Series A round, bringing to $45 million the total funding the startup received this year. Following closely is Sun Culture, which provides solar-powered irrigation solutions and agricultural technology to smallholder farmers. In April, the Kenya-based startup raised $27.5 million in a Series B round. Sun Culture was founded in 2012 by Samir Ibrahim and Charles Nichols and operates in Kenya, Uganda, and the Ivory Coast. At number 4 is Rom Motors, which is a Kenya-based Swedish electric vehicle startup. Rom in February announced it secured $24 million in a debt equity Series A round. The company was founded by Albin Wilson, Philip Lovstrom, and Michael Ganj, and it entered the Kenyan e-mobility sector in 2017. Now, initially, Rom specialized in EV conversions until 2021, when it shifted to the assembly of EVs such as motorbikes and buses. At number 5 is Pula, which is a Kenya-based insurance technology startup. In April, Pula closed a $20 million Series B funding round. The venture, founded in 2015 by Thomas Njeru and Rose Goslinga, offers insurance covers to smallholder farmers to protect them from losses occasioned by pests, diseases, and climate-related events such as floods and droughts. Pula has operations in Kenya, Nigeria, Zambia, Malawi, and Mozambique. And number 6 is the internet service provider Mawingu. Mawingu in November announced it got $15 million worth of funding, which saw it acquire the Tanzanian ISP Habari. Mawingu was founded in 2012 and is led by Farouk Ramji. The company provides shared internet packages in rural and peri-urban areas. The company is Kenya's 5th largest internet service provider with a 2% market share, and this was its first international expansion. Another deal we saw this year was with Workpay, which is a Kenyan human resource payroll provider. In August, it secured $5 million in a Series A round. Founded by Paul Kimani and Jackson Kungu in 2019, Workpay offers employers a cloud-based platform to process employees' salaries, benefits, file taxes, and keep track of their attendance and leave days. At number 8 is Ilara Health, which is a Kenyan-based health tech startup, which in February secured $4.2 million in debt and equity in a pre-Series A round. The company was founded in 2019 by Emilian Popper, Maximilian Mancini and Samia Faruqi. It seeks to improve healthcare by enabling health centers to acquire pharmaceutical products and other items on credit. At number 9 is Octavia. In October, the Kenya-based direct air capture startup closed a $3.9 million seed round to remove carbon dioxide from the atmosphere. Oh, how so, you ask? Well, the venture, which was founded in 2022 by Martin Ferrimula and Duncan Kariuki, seeks to build direct air capture machines, also known as DSC machines, to capture 1,500 tons of carbon per year beginning 2025. How it works is that Octavia captures carbon from the air and liquefies it, after which it is injected into the ground for storage. And to round it up, we have Chapter. The Kenyan e-commerce startup in September announced it had secured $1.2 million in pre-seed capital. The business was founded by Mesongo Sibuti, Kuria Kevin, Mark Kiari, and Tesh Mbabu in 2022. Chapter was revitalized this year following the closure of Mbabu and Sibuti's other venture, Reja, the distribution platform by MarketForce. Chapter provides an AI-powered commerce platform to merchants to make them sell more on social platforms like WhatsApp and Facebook by automating conversations, marketing, and payments. It currently operates in Kenya and South Africa. Now, as for the venture capital firms themselves, 2024 saw Telkom Capital close its Tide Africa Fund at $154 million for the VC to back early-stage startups. This year also, Equator Africa, a VC fund focused on the climate sector, got $5 million from the International Finance Corporation to back early-stage startups that are working on solutions in the energy, agriculture, and mobility sectors. Now, in the middle of all this, things were not as rosy for startups like the e-commerce venture Copia. The startup, founded in 2013 by former Silicon Valley maestros Tracy Turner and Jonathan Lewis, provided a platform for rural consumers to order products delivered by agents. But as this year began, Copia failed to secure additional funding, tossing one of Kenya's most funded startups under financial constraints. Copia announced it was cutting over 1,000 jobs and also warned of a looming shutdown. Now, this was at the start of the year. In May, the company stopped operations in 6 towns. All this ended up in the startup being placed under administration, where 2 KPMG partners were appointed to help rescue it. However, in September, it was reported that administrators were selling the company's assets and winding up Copia's operations. Now, to understand 2024 from the perspective of the investors deploying capital to these startups, I sat down with Adelaide Njoki, an investment associate at 54 Collective. 54 Collective is the VC company formerly known as Founders Factory Africa and has backed some of Kenya's startups like the fintech Lipa Later and the online ticketing platform Bupas. I began by asking Adelaide about some of the factors that shaped how Kenyan startups raised funding in 2024.
So there are various drivers to that trend, right? Where if you compare 2024's performance to 2023, we're not doing as well. The last 9 months, we've only done $838 million compared to like 1.3 the previous year. Again, quite low. Even the number of deals as well. I think some of the contributors to this trend is one, the fact that we're seeing a lot less Series B, Series A type deals, checks being written. So again, which drives down the value, of checks that we end up writing across the market. Then even the volume as well is significantly low. I think the thing that, apart from the dryness in the Series A and Series B deals and the low quality of deals that we are seeing at that high level, the other thing that I think we also just need to be very conscious about is not separating the African market from the global market. So it's also interesting to remember that this has been a global trend where we've seen the same thing happen across multiple markets, where at some markets, more developed markets at their peak, they did see, huge decline, which is a sign of like market contraction as well, right? So I think Latin America saw 80% dip in Q1 of 2022. North America also around like 60% dip in 2023 as well. So it's almost as if the African contraction, it's a late frostbite that we're only beginning to feel it now, right? So it's important to not separate it as if it's a it's a phenomenon on its own. Really, it's part of the trend as well.
From where we sit, it seems like for the last, say, 1 year, there's been a shift from, say, 2022, there was investors was going heavy on fintech. Yeah. But for the last year, we've seen a lot of investment being poured towards climate-related startups and also AI. What do you think? What would you say about that?
Yeah, so I think AI has been interesting, right? I think AI became a lot more popular late last year and this year as well. And we are seeing it being able to actually drive a lot of efficiency across multiple companies, right? And I think the thing with AI is, even for most investors, it's still very new, and I think we'll still see a lot more investments going into that market. I think what we might see is maybe a slight pause, since even we as investors, we need to also just learn, how exactly do we invest in this sector? How exactly do we review deals in this sector? How do we value deals in this sector? So I'd say that some of the investment that we've made will definitely be, form part of the early learnings on some of the trends that we'd see in this segment, and eventually again pick up again. Climate, my view on climate is like integrated across multiple sectors, right? So you'll see that climate is climate tech, yes, but it's like within logistics, right? So again, it's like when you're trying to solve for climate issues, you're like, at the end of the day, you're solving for like very core problems affecting multiple, like huge populations across multiple markets as well, right? So I think we'll continue to see a lot more investment in that sense. You'd find that most of these companies are actually solving like huge and real problems for people across the continent.
I also asked Adelaide about how the struggle of some of these startups shape how investors are deploying capital.
It does shape how we look at deals, because at the end of the day, what failure is a learning, right? Then also it's important to also remember that most of these failures have been baked into the VC model, where all the companies that we invest in, we don't expect all of them to do well, right? We do expect that some of these companies are actually going to fail. And something that we normally see, interestingly, within our organization is how do we ensure that we're failing fast enough so that we're also getting the learnings fast enough that you can either now build a better product, build like a better solution, like a better version of what has previously failed, or like an entirely new a business actually, right, based on the learnings that you're getting from the failed businesses. So one, the failures have been baked into the model, so it's not that it's unexpected, like it's not like it's a bad signal of what's going on in the market. It is needed, it's been baked in, and it is expected, right? But I think some of the learnings that we'd be getting is, again, it's been able to say, so this didn't work because of one or two reasons, right? At the end of the day, failures form a huge part of the learnings. And I think for me, what I'd like for people to even become a lot more vocal about is actually sharing those learnings, instead of feeling like you're beat down or this is a bad thing for the ecosystem. But really, it's not. I think there's so much that you can actually get from sharing what worked and what didn't work, which essentially would mean that you enrich the like the next entrepreneurs, and essentially it means that we're able to like build better and stronger companies.
It's interesting to me to hear that the failures are part of the investment, as in they help you learn and shape how you invest in the future. Speaking about going forward in 2025, you mentioned about there being a possible slowdown in AI as people learn and try to understand what it's all about. What else can you forecast happening in the next year?
I think the other thing that I'd forecast would happen in the next year is you see in the same way, like in the beginning we talked about the fact that we're seeing like a slowdown in deal value and deal volume. I think we'd begin to see it picking up. I think some of the signals that we're seeing in the market is, one, in as much as comparing 2024 to 2023, it seems as if we're not doing very well. Comparing the Q1 24 to Q1 23, Q2 24 to Q2 23. I think the interesting thing is the last couple of quarters, or like the last couple of months, the deal value has actually been increasing month on month, right? Which I think is a signal of investments ramping up. And I think on the background of it as well, some of the other signals that you'd see is, on LinkedIn you'd see, so when there was a dry up, it's not just for the startups, it's also for the VCs themselves, right? So investors were trying to fundraise as well. It was taking longer than it would initially take to actually close their rounds as well. But then interestingly, we're seeing some of the VC rounds being oversubscribed. Some VCs are also like receiving money, and then which essentially just means then investors will have powder to actually invest, coming into 2025. So I think those are some of the signals that would be shaping what 2025 could look like. And I think I'm quite hopeful about the deals that we'll be able to see. And I think the other thing as well is the fact that in as much as we saw, like less Series A, less Series B deals, even we as investors at 54 Collective, we've been seeing so many, high quality pre-seed and seed stage deals, which would mean then in the next 8 months to 12 months, should these companies be able to actually do well and crack the market, they will be able to raise their next round. So again, just driving that narrative of the ramp up and what to expect in 2025.
That is it for now. Remember, you can catch up on more detailed coverage about all this and our other stories on www.citizen.digital/tech. See you in the next one.